Hi, my name is Jamsi. I'm a finance professor, and welcome back to the third and final part on the discussion to the overview of the financial markets. In the previous video, we have defined what a financial market is. We have discussed the different types of markets, as well as the institutions that form part of the financial market. In this third and last part of the series, we dive in a little bit more specifically on the stock market transactions and the different theories on stock market efficiency. So let's dive right to it. So, in terms of stock market transactions, we have previously established in the last video that when you do stock market transactions, it usually happens in two markets. Now let's recap which two markets these are. Stock market transactions happen first in the primary market. Why is that so? Because the primary market is the place or the specific market where the sale of new shares of stocks by issuing corporations happen for the first time. So if you are going to buy a share of a company for the first time, meaning it is not yet available to the general public, you go straight to the primary market. If you engage in such transaction, the payment you make in such transactions, for such transaction rather, will go directly to the corporation. So it happens primarily in the primary market. So here's an example. Let's say Apple Computers decide to issue an additional class of shares with the assistance of its investment banker, and an investor purchases some of the newly invested shares from the investment bank that Apple is currently working with. So that particular transaction is a primary market transaction. Now, what happens in the secondary market? So in stocks, when you engage in a secondary market transaction, the sale of previously issued shares of stock by a stockholder happens here. And the money goes to the previous stockholder. So to expand our previous example, if the person who originally bought the new shares of stock of Apple Computers for the first time with an investment bank decides that he or she no longer wants possession of the assets, or if the person thinks that it is already time to sell the stocks, he can actually go to the secondary market and offer it up for sale. And when a new buyer comes along and offers to buy his shares of stock at a given price, that particular transaction is now a secondary market transaction because it's technically considered a second-hand ownership of stocks. Like our previous example, if you're gonna buy a new car, you go to the car dealership. Or if you're looking to buy a second-hand car, you do not go to the dealership. Rather, you go to auctions or used car lots or even the garages of banks where they park repossessed vehicles. So that's the difference between a primary market transaction and a secondary market transaction. Now we're talking about this in relation to IPOs. So what is an IPO? An IPO or an initial public offering occurs when a company issues stocks in the public market for the first time. So if we remember from the previous video, if you engage in a transaction within the public market, you are assured that the contract and the terms is pretty much standardized. And if a company decides to make an initial public offering, therefore, they are deciding to open their doors to the public for more investments, thus enabling that particular company to raise a larger amount of capital from a wide variety of investors. So, an IPO may include, let me be clear, an IPO may include new shares that are being issued for the first time, meaning during the IPO, you're also selling new shares in the primary markets and could also include shares that have been previously issued and are owned by current shareholders of the then private company. So, which means that an IPO can have transactions that are happening in the primary markets and the secondary market at the same time. So, once a company issues a new class of shares for the first time, of course, it's a primary market transactions. But once the share is issued, these particular shares are now going to be traded in the secondary market as it changes ownership from one investor to another. Now, once a public company, or once a company rather, decide to engage in an IPO, it now becomes a public company because it is now owned by the general public or outside investors. That said, they are now going to be subject to additional regulations that are often very strict and very much subject to review and penalties in case of non-compliance. That said, public companies will be subject to regular reporting requirements by the proper authorities such as the BIR and the SEC. In the recent years, one of the examples of an IPO is the stock or the IPO offer, rather, of a new convenience store, namely Mary Mart. So, Mary Mart or MM in the stock market has basically offered its shares to the public for the first time in May 26, 2020. On the right side of the screen, you see a screenshot of the IPO announcement for Mary Mart. As you can see, the stock and the stock code is actually indicated in the announcement. The offer price, meaning the price in which you can buy Mary Mart stocks in the stock market, the minimum number of shares that could be bought or could be reserved for the IPO, and the reservation deadline. So it says here that the reservation deadline was last May 26, 2020 at 5 p.m. And the mode of payment will be debited from the online account of the person who actually wishes to buy the stock. So as you can see here, this particular IPO was found online, and a particular transaction, meaning the reservation transaction, could be done by an investor through his or her e-brokerage system. So such as COL Financial, First Metrosec, and whatnot. So you just go to these platforms, and there are times where you will see the different offers coming from different publicly listed companies. So it will give you instructions on how you can get your hands on these initial public offerings. Of course, if you are interested in buying stocks from an IPO, it is assumed that you will have enough money in your brokerage account to fund the sale transaction. So, all right. I hope that's clear about the IPO. So, let's move along. So, stock quotes. What is there or what's up with stock quotes? When you start investing in the stock market, you dive into the Philippine Stock Exchange if you're in the Philippines. And usually, you will not see full names of these publicly listed firms. Rather, you would see stock quotes. Stock quotes are just short codes, usually 3 letters, that represent the name of the corporation or the name of the stock being sold. Like, for example, if you want to talk about food, JFC. When you see the stock code for JFC, when you check it means you're buying a stock from Jollibee Foods Corporation. All right? So that is an example of a stock quote. In one of our videos, I will show you how to navigate or how does an e-brokerage platform look like. So let's move along about our topic or on the topic of stocks and the stock market. So one of the last topics that I want to discuss in this video are the different theories of stock market efficiency. So there is a theory that the stock market can achieve efficiency. So when we say that a stock market is efficient, we can conclude that securities are in equilibrium and are fairly priced. So what do we mean when we say it's fairly priced? Meaning we have all the right information to judge the stock based on the information that we have on how much it's supposed to sell. So, for the rational traders, meaning those people who buys and sell stocks, if the stock or the market price of a stock is too low, then these particular traders, when they see that a particular stock is priced too low, will take advantage of this opportunity and buy the stock because it is on sale. And by virtue of law of supply and demand, if the price is low but the demand is high, eventually the price of the stock will be pushed back up to the proper level. So when we talk about stock market efficiency, we can definitely say that investors will not and cannot beat the market except through luck or the possession of better information to be used to make better decisions. So let's see the different theories or the different forms of stock market efficiency. So there is what we call the efficient market hypothesis. The EMH states that there are different levels of stock market efficiency. To be specific, there are 3 levels that have been identified. So let's go through them one by one. First, we have the weak form. The weak form of the stock market efficiency states that information on past stock price movements could not be used to predict future stock prices and beat the market. However, published and inside information can be used to beat the market and make profits. Now, what does this mean? So in the weak form, the trend on past stock prices or any movements of the stock price are irrelevant and could not be used to predict stock prices. You may only use published and inside information to beat the markets and make profits. So in the weak form, it simply means that you will have to rely solely on the information about the stock and the company that is out there and released to the general public, and any other inside information that you can get your hands on in order to beat the market and make profits. But mind you, insider trading is illegal. When we say insider trading, you use insider information to beat the market and make a move on a particular stock. It is illegal and it can result into jail time if you are proven to have engaged in insider trading. So, if there is a weak form, there is what they call a strong form, or a semi-strong form rather. In the semi-strong form of market efficiency, it states that all publicly available information is immediately reflected in the stock prices and cannot be used to beat the market. But inside information can be used to beat the market. So let's differentiate the weak form from the semi-strong form. The weak form says that any trending on the stock prices could not be used to predict future prices of the said stock. But you will have to rely on published information that is available to the public and any insider information that you can get your hands on. On the other hand, the semi-strong form tells us that while there is publicly available information, it is no longer of relevance. Why? Because all publicly available information has then been considered and has been taken into account into pricing the stocks. So whatever the price of the stock is now is the result of the publicly available information and any trends that have happened in the stock prices in the past. So this means that if the stock market is in the semi-strong form, you can no longer use the past prices or the historical prices of these stocks and the publicly available information. You can only rely on insider info to beat the market. But like I have said, insider trading is illegal. Therefore, you cannot use insider information to beat the market. All right, now there's a third. And actually, I preempted myself, inunahan ko na, by saying or by stating the strong form. So, the strong form states that even insider information known by company insiders such as managers are irrelevant and could no longer be used to beat the market and make high profit. So if the stock market is in the strong form, not even insider information that is exclusively known to the decision makers and other company insiders could be used against the market because it is assumed that all information, known or unknown, has been taken into consideration in terms of pricing the stock. So, if the stock market is in the strong form, kung ano yung presyo ng stock in the stock market, that is a result of all information that is available about a specific stock. So those are the three levels of market efficiency according to the EMH. So let's expand that a little bit. There's what we call an efficiency continuum. So others believe that the market is not efficient. However, most observers believe that there is an efficiency continuum instead, meaning market for some of the company's stocks are highly efficient, while the market for other stocks are highly inefficient. So instead of putting it in black and white, are we efficient? Are we inefficient? There is a sliding scale, and the scale varies depending on what kind of company you are on or you are in. So it says here that small companies that are not followed by many analysts nor have not much contact with investors are usually within the highly inefficient market. So why is this so? Because no information or minimal information is available regarding these small companies. Why is that? Because there is not much followers, nor is it in the watch list of many investors. Thus, these small companies are considered to belong in the highly inefficient markets. On the other hand, the large companies, followed by many analysts and have good communications with its investors, are considered to be part of the highly efficient market simply because these larger companies are more well known and most of the analysts and the investors will really keep their eyes out regarding these large companies because any slight movements or changes in terms of management, earnings, or if there are triggering events, it will immediately show in the stock prices. Therefore, these large companies are considered to be highly or to be part of the highly efficient market. So this is an alternative to the EMH. All right. So if we're if we're talking about the stock market efficiency, let's talk about the reasons why the market is inefficient. So let's see. Here are some of the reasons why the markets or the stock markets is inefficient. Number one, it is costly and risky for traders to take advantage of mispriced assets. So basically what we're saying here is I don't want to take the risk on an asset that I don't believe is priced correctly. Sino ba naman ang magkaka-interest sa isang bagay na palagay mo hindi worth the value of your money? Second, there are elements of cognitive biases that cause investors to make systematic mistakes that lead to inefficiencies. So this is an area of research known as behavioral finance. So the market becomes inefficient because even if there are information available, our judgment is still impaired because sometimes we do not believe in the information because of our personal biases and personal convictions that influence our buying decision. And this is a factor of behavioral finance. Now, behavioral finance is the study of the influence of psychology on the behavior of investors. It focuses on the fact that investors are not always rational and are influenced by their own biases. Basically, it's like impulse buying. If you see something is good, then you just might think that it is good without actually thinking the decision through. And you just let your personal biases take over a purchase or an investment decision. The study of behavioral finance borrows insights from psychology to better understand how irrational behavior can be sustained over time. One of the examples include evaluating risks differently in up and down markets. So, if we have this personal bias in terms of our investment decisions, we tend to shift gears or we tend to shift perspectives depending on the situation of the stock market. Meaning we are not objective and we do not make our decisions fairly because we adjust our expectations depending on the current market situations. The second example is basically one of the common signs of behavioral finance. Sometimes you are overconfident in something. And because you are overconfident, you feel like you are correct and you tend to be blindsided. Kakalimutan mo na lahat because right in front of you, you feel like this particular investment is worth every penny. When in fact, there have been red flags raised. So now that we have talked about the elements of the stock market, the reasons why it's inefficient, the theories of how it could be run efficiently, let's take a look at the implications of market efficiency. So let's take a look at this example. We hear a news that a medical research company received FDA approval for one of its products. If the market is highly efficient, can you take advantage of this information by purchasing the stock? So, what did we say about highly efficient markets or strong the market being in its strongest form? When the stock market is in its strongest form, therefore, no amount or kind of information will be used to beat, or can be used rather, to beat the market. So if the market is highly efficient and you hear the news that this particular new drug by a famous medical research company has received FDA approval, you cannot use that piece of information to take advantage of it and relating it to your investment decision. Because if the market is highly efficient, this particular information will automatically be reflected into the company's current stock price as soon as the company, or as soon as the announcement hits and it arrives to the public. And that, ladies and gentlemen, ends chapter 1 of our lesson in financial markets and institutions. In the next few chapters, we will go through the different markets within the financial markets systems. And until then, I will see you soon. Don't forget to watch parts 1 and 2 of this overview. If you like my content, please like and subscribe to my videos. Until then, I'll see you soon. Bye.